Hey, good morning, everyone. Dan McCarthy here. Together with Loretta Besson, we want to welcome you to our webinar today. I'm sure you're familiar with our current webinar series on financial wellness. This is the one that's geared toward your participants and employees, and it covers various topics like understanding Social Security, 401k basics, long-term care planning, etc. And just as a reminder, these previously recorded webinars are going to be found on our website, gouldandmccarthy.com. This morning's webinar is the first in what we hope to be a series of webinars focused on you, our clients, and plan sponsors, with the overriding goal of making us better fiduciaries and stewards of 401k plans. With that, I want to introduce Greg Schiffko. Greg's a 401k industry veteran. He spent the last several years with Fidelity Investments and currently serves as the Vice President and Regional Retirement Director. Today, Greg's going to walk us through a couple industry studies that Fidelity's performed, one on industry trends, and that's with respect to behavior from 401k participants, and the other is their annual plan sponsor survey. This is to give us a better understanding of how companies view their 401k benefits and what they're doing to improve them.
Great, thanks, Dan. Just a couple of housekeeping items. We will be recording this webinar as well, so we're happy to share a replay of the content following the presentation. During this session, we will not be taking questions, so certainly if you have any follow-up questions, feel free to reach out to Dan or myself. We are always available to assist, and as Dan said, we're going to be going through some really interesting content as it relates to trends. And so I don't want to steal any of Greg's thunder, but with that, I will turn it over to Greg.
Great. Thanks, Loretta, and thanks, Dan, and good morning, everyone. I really appreciate being on the inaugural WebEx for Gould & McCarthy. That's exciting. Hopefully, the two presentations that I'm going to share with you, you'll find of value and impactful. I just want to, before we jump into that, I just want to make sure, sound check. Do I sound okay, Loretta? Do you see the presentation on the screen today?
Yes, yes, all clear over here. Perfect.
Oh, fantastic. It's always the first concern. So, as Dan alluded to, I'm Vice President and Regional Director for Fidelity. I've been in the industry a little bit over 20 years. About half of that time has been spent with Fidelity on the qualified plan side, and I'm excited to, as Dan mentioned, present two of our most popular presentations. Quite frankly, one is, as you see on the screen today, is our Building Financial Futures. And the second that I will also share some excerpts from is our plan sponsor attitudes. And as Dan said, the first presentation is really going to focus on some trends and insights that we see from our block of business at Fidelity. And then as we shift gears into the plan sponsor survey, we're going to broaden the presentation to really take into some thoughts from across industry, across record keepers, and hopefully you'll find all of that dynamic and hopefully helpful. As we start off, I think it makes sense to make just take note and make a quick comment regarding the way that Building Futures is set up. So Building Futures really is a snapshot of our block of business, as I alluded to, which is really the largest proprietary database of plan sponsor and participant information in the industry. It encompasses our over 25,000 plans and over 25 million participants. So it's an excellent cross-section of information. And as a setup, I really encourage everyone on the phone to really look at this as a benchmark exercise. And what I mean by that is many of you, if not all of you, are actually participants in their plans. And so if you want to take a look at it from your own personal situation and be able to take a look at where you stand to some of the averages that I'm going to share with you out there. And then obviously many of you are also responsible for the workplace plan as a plan sponsor. And it's a good way to take a look at how is your plan stack up across the industry from the averages. And great opportunity then to really go back to Dan and Loretta and use some of this information to continue planning, as I'm sure you're already doing today. This is put out, as I mentioned, quarterly. So as of note, it makes sense to really understand that this is Q2 of 2020. And so as you can probably guess, that's just at the beginning of the pandemic. So one of the promises we're going to make is to really keep an eye on any of the changes and the trends and really give you some feedback as the year goes on and see if we've had any dramatic changes to some of the data that I'm going to share with you today. Our focus for time, although Building Futures is pretty broad, as you can see, we're going to focus on just statistics as it relates to the defined contribution plan marketplace. So the first place I really want to jump in is to really look at DC plan participation. And I think what is very encouraging, as you can see, is participation rates over the past decade have really continued to climb. We're up, as you see in the upper right-hand corner, just over 73% from a participation rate. The auto enrollment really proves, auto enrollment features that have gone in recently really have proven to be the changing force in that increase. And I think it's interesting to really take a note that 90% of employees who are auto enroll don't opt out. I think sometimes we see that if you're considering auto enrollment as something in your plan, if you did not utilize it today, you're always curious about what the impact is, how many people will opt out, what is the take-up rate, and we continue to see a very large uptake and remain in that auto increase program auto enrollment program. The participation among millennials, if you take a look at on the bottom left-hand side, is also very encouraging. If you take a look at it, it's increased by 55% over the last 10 years. So I think, again, employers adopting auto enrollment are benefiting on both the millennials, the newer participants, as well as ongoing with their general participation in employee base. Next page looks at, if you look at participation and you take a look at average account balance, pop back one and take a look at the savings rates. Contributions have really held steady over the past decade. We're looking at about 9.8% of participants contributing to the plan have decreased their deferrals in Q20, which is really up from 8%. So if you really look at over the past year, although this is the pandemic quarter, I think we haven't seen that huge of a drop. And again, we'll keep an eye on that. But participant rates, total contribution rates have remained steady at about 13.4%. 65% of those deferral increases were also to the auto increase program, very similar to, you see the impact of auto enrollment. I think one of the questions we get on the actual contribution rates on there is, of that 13%, how much of that is participant driven and how much of that is coming from the plan sponsor from an employer contribution? And if you look at the 13.4% total contribution, just over 8% is coming from an average employee contribution. It's about 8.3. The other 5% obviously comes from the plan sponsor to get you to your total at 13.4. One of the things
Thanks,
that we
Greg.
like,
you answered my question, because I was just going to ask that, and that's great, and that's sort of in line with what we're trying to shoot for with our plans of that 10 to 15% savings rate. So thanks for pointing that out.
Yeah, and I think what also is important, Dan, is to kind of look at when we think about that total contribution rate, and as you alluded to, what you're just like Fidelity, we're both trying to encourage the participants to really get into that 15% savings rate. One of the things that we've done to make that a little bit easier, and I know you share with some of our joint clients, is how can we give some goal markers for that participants, or a little check-ins for as the participant continues to contribute over time. We look at that 15% as being a way to get that successful financial readiness at a normal retirement age of 67. And some of the markers we use is, if we're saving at that 15% rate, we're really looking to be able to accomplish what we would hope is a 10 times your final salary at retirement is a goal. So if you look at you as a participant turning 67, we're looking at having about 10 times your final salary in your retirement account to be able to make yourself retirement ready. And if you're hitting that 15% savings rate that you alluded to, Dan, you should be able to really get there very comfortably. Some of the goal markers that we've had out there to see if you're on track is we really have 5 goal markers. At age 30, we try to tell participants to have about 1 times your salary in savings. At age 40, we look for 3 times, 50, 6 times, 60, 8 times, and then finally at retirement age of 67, 10 times. So again, taking a look at the different decades is kind of a benchmark, again, to give you a good rule of thumb out there. And that works very well for participants within that income level of about 50 to about 300,000 very effectively. So hopefully that's helpful, and as we share those as we go forward. I jumped ahead before, but back to I think one of the most popular things we see is when you go onto your phone or you log into the to Net Benefits. What's the first thing that you're always taking a look at is what's my balance, right? And I think that's definitely the first thing that we want to see. And I think the good news is the balances have grown significantly in recent years and held steady at just over 100,000. And if you look at with recent market activity, it's even rebounded about 14% from the previous quarter. So that's all great news. What we also like to point out when we speak to participants is obviously the importance of continuous investment. Continuous investment over time utilizing dollar cost averaging. And as you can see, bottom average balance continuously invested is growing nicely. And under the additional insights piece, again, that take a look at the millennials have continuously invested in their DC for 15 years, have an average balance of just under 200,000, which is very encouraging. Next page really talks about investment diversification. And I think it's improved greatly over the past decade. If you take a look at 2010, when you had percentage of employees holding 100% of their dollars or nothing in equity, I think really we like to say that we think that impact has really been is the advent and popularity of the target date fund. And it's really encouraged with the majority of businesses and plan sponsors offering target dates and the utilization rate continuing to go up. It's certainly greatly improved diversification. What I like to note being down in the bottom and under the insights piece is surprisingly baby boomers are the most likely generation to be too aggressively invested. A lot of people ask us are they too conservative? And I think our data has shown over time that it's actually the opposite. And using and encouraging things like asset allocation programming, target dates, and the like have really greatly increased. And from a number of years ago, I think we've gone away from the percent of employees with pure stock allocation as well. So I think those statistics are encouraging, and we hope that they continue. Trends in the DC lineup, and this really talks about investment options. And one of the most common questions we get is, regardless of plan size, what do we see out there from the number of investment options offered? And although it focuses on the slide of larger employee, I would say that the average number of investment offered really stays really consistent around 16. Regardless of size of the plan. And I'm sure, Dan, you've seen a similar type of experience with the clients that you're currently dealing with.
We have, and we've seen the studies where less is more, right? And sometimes when you have too many investments to choose from, it sort of becomes deer in the headlights, and participants shy away from even participating. But if you keep that menu down to a good amount of choices for adequate diversification, coupled with the target dates. And I guess my question to you, Greg, is, that 16, I'm just want to clarify that, plans that are using a target date series, that's exclusive of that 16 or maybe one choice in that number. Is that about right?
Yeah, that's a great question, Dan. Absolutely. So when you look at 16, we're including target dates as one investment choice, even though, as you know, some target date series can have 8, 9, 10 different funds in the series. That 16 number includes target dates as one. So target date is one, 15 other choices out there to fill out the style box. So
Great.
absolutely,
Yep, that's
great
sort of what we
question.
are seeing too in our client base. Perfect. Yep.
Yep. Shifting gears a little bit, and we'll take a little bit from the next two slides. Really focus on loans and withdrawals, and this slide in particular really sees a trend that loans are trending down, not significantly, but it's worth noting. And again, what I mentioned at the beginning of the presentation is that we're obviously in the pandemic, and we really want to comment on really the impact that most employers have chose to adapt the CARES Act distribution provisions. And many of those participants out there have opted to use this instead of a traditional loan. So we want to make sure that we're keeping an eye on that loan usage over time and see if that's going to continue to trend down based on that and what impact that has over time. But the next page talks about withdrawals in general. And that really, you take a look at the withdrawal out there is overall money out activity is only slightly higher in Q2 over Q2 of 2009. But in Q2, 7% of participants took the money out of their plan, with the CARES Act distribution representing about 38% of those transactions. So in other words, 7% took a withdrawal, and of that 38% of it was the CARES Act withdrawal in particular. And I think one of the questions we also get and people are keeping an eye on is, what was the last bullet there on the left is, what was the average CARES Act distribution? And it was just around $12,000. So I think there's just a good idea to take a look from a median and how that really compares and what you're doing from a plan sponsor participant usage.
And Greg, I imagine, depending on what industry your company is in, you're going to see more CARES Act distributions than others, right? So I got to imagine airlines and hotel and hospitality, you're probably seeing a lot of CARES Act distributions. Knock on wood, our client base hasn't seen a tremendous amount of those, which is great, but it's good to see these averages and it all play out. And more importantly, good to see that there hasn't been a tremendous run on 401ks distribution. So great.
I think it's a great point, and I think one of the things that we're poised to do is we put this presentation together over the subsequent quarters. We're actually going to have a slide in there that tries to break that down by industry to really take a look at the point you made, Dan. Is it an overall, or are we impacted by the industries that you alluded to that we would suspect would have that type of activity? So it'll be interesting to see over the upcoming quarters how that plays out for sure. So.
Perfect.
Well, that kind of concludes just from the building futures perspective. I want to shift gears a little bit and kind of go over to our plan sponsor attitude survey. And as I mentioned, Dan, can you see the plan sponsor attitudes survey on the screen?
Yeah, we can see it.
All right, fantastic. And so to really compare and contrast a little bit, the difference between some of the screen and information that I just shared on building futures, if you remember, really focused on our block of business, the Fidelity block of business that we record keep and oversee on a participant and sponsor basis. What the plan sponsor attitude survey does is takes a little bit broader of a look. As I'm going to share in a minute, it really looks at over 1,500 plus plan sponsors that took part in this from a variety of different record keepers. What I think is interesting here is this is our 11th edition of this. And what's really great is to be able to take a look back now and see some of the changes in the trends that we've seen over time. And I'll highlight a couple pieces of that. As I mentioned, this is the outside book of business, 1,500, which, by the way, the 1,555 was the largest participation that we've had each year. It's really, that number has grown significantly. And again, what's interesting is, unlike building futures, we actually hire a third-party firm to go out and survey. So it's not just Fidelity, as I mentioned, it's all record keepers. And as you can see, it's a pretty broad from a respondent's job function. I see it down the left-hand side, you can see we have a nice array of finance, human resources, business owners, as well as taking a look at plan sizes. If you look at the middle of the screen, you can see we have a pretty broad array. A lot of people sometimes when I'm doing this live raise their hand and say, hey, look, you had a 15% of these plans over 250 million. I understand that most of the people we have on the phone today probably aren't there. But I think one really important thing to note is what I've seen over the years is that all of these trends that take place up market and they originate there usually trickle down, and it's just a matter of time to it really takes hold into all plan sizes. So it's always interested in taking a look at what we're hearing from those plan sponsors as well. And then in the bottom is just respondent key decision making. They're making decisions on the plan. You can see that the folks we've spoken to are really impactful and with their actual plan. I'm going to go just, a comment on just I mentioned the history of this that goes back. I've actually been personally involved since 2010. Early on, I was actually, part of writing some of the questions in the survey and putting this presentation together. So I love seeing this on an annual basis. But what's really, what I find is each year tends to have a theme that we were able to glean from that. And I think two important things that I think you'll see really show themselves a little bit later in the few slides that we have is if you take a look at 2017, or excuse me, 2013 in particular, that was right around the year where there was a very large outreach for really what we would call a more knowledgeable advisor. And I think in the marketplace, being in this my entire career, what I really see is I deal with investment professionals every day like Gould & McCarthy is, that was the time we really went from that generalist advisor to a more specialist firm like you see with that Dan and Loretta really represent. I think it wasn't uncommon, especially on the smaller end of the market, where you may put your plan in because someone's doing your health care or they're doing your personal finances, but they may or may not have a really strong background in this. And I think that's when we really saw that demand start to increase. And if you go over to 2017, it really was the impetus after the fiduciary focus on the Fiduciary Act and things. Although it didn't come to fruition, it certainly baked in a lot of demand for making sure that my advisor was a specialist and they could help me really be more knowledgeable across the board on fiduciary plan design, and you see the expanding impact of that. So it's a great piece and we'll share a little bit of what we see from a trend perspective. If you look at just a couple comments, really just again on the then and nows, and I'll just focus on, I think really two impacts. Is one on the right-hand side is number of folks working with the advisor, that's a metric that'll kind of agree with some of the change to the more knowledgeable piece. And then what I thought was really encouraging is the last two, satisfaction and really receiving good value from that advisor consultant has went up tremendously over this past decade, especially 50 to 72% as we look at that satisfaction rate. So what I'm going to focus on just really in the final few minutes that we have today is, again, broad presentation, but for the sake of time today, I think there's two areas that we wanted to make sure that we focus on. One was retirement readiness. And although a broad term out there, it really remains in focus in a different way, a bunch of different ways for plan sponsors. And then also just sponsors seeking advice on total benefit spending. So we're going to make a couple comments on those and hopefully share some insights as we go forward. So let's shift over to retirement readiness and really look at very surprising right out of the gate is 59% of plan sponsors believe that their employees are saving enough for retirement. And I think if you look at the left-hand side, if you look at just about 60% believe their employees are ready. I think what's interesting is really to kind of drill into that a little bit. And if you take a look at, of that, 71% was the owner, the CEO, or the president. believing that their employees were ready. But if you take a look at the human resource side of it, and we like to think that most HR directors have their finger on the pulse, so to speak, of what's going on, they may be a little bit less optimistic on the really level of retirement readiness overall. But when you look at what is preventing the participants from saving enough for retirement, I don't think too much of that is probably out of the realm of what we would think. But obviously, current living expenses, lack of disciplined savings, healthcare costs, and things which we're going to talk about in a moment. What we're also poised to take a look at in future presentations is what impact obviously did COVID have, the pandemic that we have, and we'll take a closer look, as I alluded to before. So if you look at most savers have a retirement shortfall, and if you look at about 1/3 of the employee base out there, feel that retire early, right? What percentage of your employees would you estimate? So plan sponsors think about 1/3 of them. But if you look at on the right-hand side, how many employees are delaying it due to lack of retirement savings? It's really 60% of employees that they are really going to delay retirement, and we'll show in a second some of the reasons why. So a little bit of a disparity there. Some plan sponsors believe employees are delaying retirement can benefit the company, but most do not. So what does this really show you? It really says, what is the impact of this employees delaying on both a benefit and a cost perspective? So if you look at the left of the 67% is really, plan sponsors indicate that there is no benefit really for any of their workforce to delay. And as a matter of fact, they'll cite things like increase in cost to the company, reduces mobility of some of the younger workers. So from a benefit perspective, just over 2/3 are saying no, that doesn't help. And really look from a cost perspective, they indicate the company benefit. 33% indicate company benefits from workers delaying retirement. Out there, the government company benefits at 31%. So you kind of see a big disparity, the 60, 67, and 33% of that impact. And 74% of sponsors indicate that cost to workers, there's a cost to that worker in delaying. So it probably doesn't come as a surprise to most from a plan sponsor viewpoint. The last section we really take a look at, as I mentioned, is really total benefits spending. And I mentioned earlier really the trend to look at the more knowledgeable advisor. I think one of the trends that we're certainly seeing from a record keeper perspective is really the trend for that advisor and partner to really assist more broadly. How do we look at things that impact you across the benefit spectrum, whether it's payroll, whether it's HSA, whether it's charitable giving, healthcare? That next generation retirement specialist, as a matter, takes a very much of a more holistic approach to what we have out there, and really helping you make decisions a little bit more broadly. So you look at some of the past themes that we've seen. Is what's interesting is when asked the plan sponsors is from a benefit perspective, what has been obviously top of mind. And for years, obviously healthcare costs had dominated. But as you can say, what's somewhat surprising, at least to me, is really the narrowing of that. And when you look at the benefit program, that's a most important focus. And if you look on the left-hand side, we really, take a look at that narrowing over the past couple of years and the importance of health to retirement. And I think more specifically is, especially as the plan size increases, I think that overall narrowing of importance is more dramatic as you look at plans from going from 3 to 9, 10 to 25, and 25 and up. We'll see if that trend certainly continues. And then lastly, most plan sponsors report that health and retirement benefits compete for funding, right? So I think if you look at some of the statistics here, about 48% are half implementing wellness programs out there to really help employees track their health. I think beyond it, the just wellness as it would relate to healthcare, we're seeing a dramatic increase in plan sponsors coming to us and asking for other things that I alluded to earlier around wellness, such as, do we offer a high deductible healthcare plan? Do we then couple that with an HSA? Do we help incorporate that holistically as we go forward? So hopefully that really concludes, the prepared comments that I had today. And I certainly thank all of you for your time and attention, and I thank the opportunity from Goldman McCarthy to make my comments today. Hopefully you find all of this informative and of some value. If the complete presentation will be available if anyone wants that as we go forward. But with that, I'll certainly turn it back over to Dan and Loretta to kind of wrap things up.
Yeah, thanks, Greg. Appreciate it. And really interesting, obviously, on the total benefit spend. We're more and more trying to engage our clients in that conversation and, where those benefit dollars are, how to use them most efficiently. Obviously, healthcare gets a preponderance of the attention due to the dollars spent. So I think we'll continue that conversation because it's becoming more important as costs increase. That's it on our end. Loretta, do you have anything on your end?
Yeah, no, that wraps it up. I just wanted to pop our information on the screen there. I'm sure you all have our contact information, but certainly feel free to reach out to us. As Greg said, the full presentation as well as the recorded content will be available, so I will certainly follow up with you guys on that if anybody's interested for that. With that, again, we thank you all for your time and enjoy the rest of your day.
Thanks, everyone.
Thank you.
Thank you.